Now the bourse trading above that 3,500 points mark, continuing to surprise on the upside. What are your thoughts on the direction that the bourse is taking at the moment?
I don't know if I'd really call it a surprise, although it is a good sight to see the index at these levels. Considering I think most chartists were actually expecting it when the index crossed the 3,400 level, then dipped below that, then came back over it, came back above that level. So I think the only way was up. And I think what will happen, I think as we cross over the 3,500 mark, I expect the market will start to trade rather sideways, as has been expected for most of this year. We've seen a lot of foreign interest. I mean, actually most of this week up to today, we've had a net inflow position from foreign investors, and also a lot of local interest from local fund managers. So it's a pretty good sight, and especially I think most of them looking at the way rates behaved over the last 2 weeks. I think it was actually an incentive to come into the equity market.
Coming into the equity market, but if we move to the fixed income and money markets aside, prime rates have come off, with the 91 Treasury bill touching a rate of about 15.93%. Now the 15% level is seen by the market as a psychological resistance level on those prime rates. Could we perhaps see those rates trading below that 15%, that psychological 15% going forward?
Going forward, I think what we might actually see especially for example, the 91-day T-bill, is probably for it to trade. I don't expect it to trade at below levels of, to come in at levels of below 15% until probably we're into the second half of this year. As you've said, it's most of the market feels that 15% is like a psychological support level, if you'd call it that. So we don't expect it to go below this. And also, I mean, most analysts were forecasting that probably by around June, which is actually about 2 months away, that the inflation and probably would be around the levels of 15. So what we might actually see in the prime rates is them holding at levels of about 15% probably for the next, up until the end of the third quarter.
Prime rates holding at about 15%, but if you look at the interbank market, the interbank rate strengthened to levels of about 17.1 as of yesterday, and today's average is expected to move to about 18%. What are you making of these rates, and where is the rate likely to hold?
I mean, it was expected. The rate came down to as low as an average of 10.3 last week, and there were even interbank trades that went through at about levels of 9.5%. Of course, CBK came in and mopped up all the excess liquidity from the Treasury's expenditure and also from maturities in that week. So as expected, the interbank rate has begun to move upwards. It's actually been moving upwards by about, I'd say an average of about probably 85 to 100 basis points every day. Yesterday it was at 17.1. Today we expect it to close at 18. Although the market feels that CBK wants to hold the interbank rate at levels of about 18%, which is where the CBR is. But considering CBK is mopping up more monies next week as the T-bills that were auctioned this week get value on Monday, I expect that the interbank rate may continue moving upwards, probably settle around levels of 19 or to 20%.
Now, look, keeping with Treasury bills, the Treasury has said that it has hit its borrowing target for the full year. Could we perhaps see a run for Treasuries on the back of this?
Yes, of course. It's quite surprising. They've actually hit the target. I think at the end of the second quarter of the financial year, no one ever saw us at this point. But they've actually met the target, and we expect borrowing to decline rapidly enough, and probably some auctions might be suspended. Especially if you look at probably the first example is the 2-year that's being auctioned next week. They're only looking for 5 billion instead of the traditional 10 billion they usually come to the market for. And we have about, if I'm not wrong, about until the end of this financial year, we have about 30 auctions, and which will pick about 69 billion if all of them go through T-bill auctions. And maturities for T-bills are about 45 billion. So I think probably, and some of these auctions will be suspended. And that's why we are expecting a run on the secondary market. As we've seen this week, it's been a very active week. Straight trades on the secondary market actually have made up about 65% of market activity, compared to 35%, repo transactions. This has not been the norm for probably the last 1 year, where we've seen repo transactions making up most of market turnover. So this is actually quite new, which shows there's a lot of people interested in the market. We've actually seen investors who had sat out, insurance companies coming in to pick papers at the long end, 30-year, 25-year. There's quite a bit of demand at that level. As everyone expects, probably this 2-year, there may not be another bond issue next month. So we might see a lot more interest in this 2-year, which we expect probably at levels of between 14 and 15%.